Can a trader still trade well when capital is the constraint? I've been trading for years, but recently I wanted to test something. Not my ability to predict the market, not how much profit I could make. Something more fundamental. What happens to a trader's decisions when capital becomes the constraint? Because when you have enough capital, you have room for volatility, room for mistakes, room to be wrong. But when you don't, every decision becomes exposed. And I wanted to see that for myself. So I started a small futures experiment. The amount I transferred into the account was just $2.65. And no, this isn't a challenge to turn $2.65 into $100. I'm not interested in making a small account look impressive. The amount is simply the constraint. The experiment is about something else, decision making. I opened two positions, grass and pie, both long, but they produced completely different stories. Grass was entered around 0.2923. The position developed in my favor. Eventually, I closed it around 0.2997. The realized profit was about $1.40. Nice result. But the number itself wasn't what interested me. I wanted to know, was the decision good, or did the market simply happen to agree with me? There's a big difference. Then came pi. Entry 0.08762. This time, the market didn't develop the way I expected. Price moved against me. And eventually, the position was liquidated. Approximately $0.97 lost. So now I had something much more useful than a winning trade. I had a contrast. One decision produced a profit. Another produced a liquidation. And that's where the real analysis begins. Because traders love to classify trades: winner, loser, good trade, bad trade. But markets aren't that simple. A winning trade doesn't automatically prove that your decision was good, and a losing trade doesn't automatically prove that your decision was wrong. The outcome is only the final point of the story. The real question is, what was happening before the outcome? That's something I've learned from years of trading and from more than 2 decades in automotive body repair. When a damaged car comes into a workshop, you don't simply look at the dent. The visible damage is only the surface. You need to understand the impact, where it began, how the structure responded, and what actually changed. That's how I try to look at the market. Not just the price went up or the price went down, but what changed, what remained valid, and what would prove my decision wrong. And this is where the small account becomes interesting. With a larger account, you can sometimes survive a bad decision long enough to convince yourself that it was still a good one. With very limited capital, you don't get that luxury. The market forces you to confront the consequences. That's uncomfortable, but it can also be useful because it exposes your decision making. And then something unexpected happened. The experiment didn't end with that first pie trade. After that position was liquidated, I opened it. The market started moving in my favor. While I'm recording this video, that position is showing around $1.65 in unrealized profit. I also have a jelly position that's currently slightly positive, but I'm deliberately not calling these successful trades. Why? Because they're still open. The profit isn't secured. The market hasn't finished. And I don't know how this story ends. That matters. Because I could wait until everything is finished, look at the final result, and then make a nice story out of it. But that's not what I want to do. I want to document the experiment while it's happening. The decisions, the uncertainty, the mistakes, the unexpected outcomes. Because that's where the real learning is. And I think this is also what trading has taught me about myself. I'm not interested in becoming the trader who is always right. That trader doesn't exist. I'm more interested in becoming the trader who knows what to do when he's wrong. Because being right feels good. Being wrong teaches you something, and sometimes the second one is more valuable. Today, the wallet balance is around $3.05. Current equity is around $4.83, including unrealized profit. But I'm not going to celebrate that number, because today's unrealized profit can become tomorrow's loss, and one good trade doesn't prove a process. Consistency is built over time. That's also why I'm not building this channel simply around results. I'm not here just to show, look, I made money. And I'm not here to pretend, look, I know exactly where the market is going. I use this channel for something much more personal. I like to think, I like to observe, I like to test ideas, and I like to share what I discover. Trading gives me the problems, experience gives me the perspective, and YouTube gives me a place to put those thoughts together. So this isn't really a story about $2.65. The money is just the constraint. The real experiment is much bigger. Can a trader remain disciplined when capital is limited? Can you make decisions without letting the size of the account dictate your behavior? Can you accept being wrong? Can you protect what you make? And perhaps the most important question, can you build a process that deserves more capital? I don't know where this account will end up. Maybe it grows. Maybe it doesn't. Maybe the next trade is a winner. Maybe it's another lesson. I'm okay with not knowing, because I'm not trying to manufacture a success story. I'm documenting a real experiment, and I'm going to let the market write the next chapter. So, if you want to follow the experiment, subscribe to Bias Positive Digital Rise. Not because I can promise you perfect trades, not because every position will be profitable, but because we're going to observe what happens and learn from it. And maybe along the way, we'll discover something more valuable than a profitable trade. We'll discover what kind of trader we become when the market doesn't give us what we want. This is Bias Positive Digital Rise. Still learning, still observing, still thinking, still trading, and still building.